All right, well, let's continue to digest the Fed speak and the market reaction, or lack thereof, with Alex Morris, FM Investments CIO. So, Alex, as we're looking at the market reaction today, it's still relatively fat. It appears that the markets have already priced in what they think Powell is going to say at this point. What's your take on how the markets are reacting?
I think the markets are finally reacting appropriately to Chair Powell's responses. For a long time, whenever the chairman would speak, markets would misinterpret rally, and then he would go on a relatively abrupt campaign to bring them back down. But now they've appropriately priced in the messaging, and the messaging has been much more consistent, not just from Chair Powell, but across all of the governors, which I think has brought some calm to the equity markets and some normal behavior to the responses and to the comments that he's made.
And we know that other overhangs include what we're going to see in terms of a recession. And as we look at the further deepening between the 2 and the 10-year bond yield, obviously one of the signals that indicates a recession could be here. But then you also have a strong labor market. As you look at some of the nuances in this, how do you position yourself in this sort of environment?
Well, we think investors are going to do well in the credit space and certainly in the U.S. Treasury space. Probably more on the short end of the curve than on the mid end or certainly on the long end. Most of the smart investments we see today seem to be in the 3 years and under space. As you noted, where the 5 years trading today and the 2 year trading above that as well provides a very attractive return. We see short-term corporate debt probably in the 5.25 to 5.5 space over the course of the year, and a substantial number of issuances in the corporate credit space, issued all under a year, all with very attractive coupons. I think that's probably a good place for investors to be. We've made that easy to invest in the Treasury space through some of our single Treasury ETFs. And we see a lot of activity on the 2 year and the 90-day products and our 1 year product as well. And think that folks in T-bill, O-bill, and U2 are probably in the right space. And we'll continue to see flows there because it provides a good yield and an attractive, safe investment in the Treasury, underlying Treasury.
And what kind of timeline are we looking at? Because you've said in your notes that 2023 will be the year of the bond. Why so laser focused on that?
Well, if we look at what happened in the equity markets in 2022, things didn't go as planned. And certainly a good chunk of what had happened over the prior decade and beyond that was as a result of interest rates coming down. There was no more down to be had last year, and a new rate cycle started. We think when that happens, there'll be a return to credit as folks now can get an actual attractive return from credit, which they couldn't get in the prior 5 or 10 or longer period of time. And I think that is going to refocus institutional allocators away from equities in general and in towards a good and diligent credit underwriting effort that was much more common even 10 years ago, 15 years ago. The question is, are there enough folks on the desk who remember what those experiences were like, who can actually go in and do that good credit work and then be rewarded for those energies?
And I want to take a look at what we're seeing with some of these S&P predictions. You're expecting about 4,100. The more bearish Michael Wilson from Morgan Stanley predicting the S&P could fall to as low as 3,000 points. What is the bullish case as to what will drive that?
Well, I'm hopeful that 3,000 isn't the case, as that would be 800 points south of where we are today. I think the consensus tends to be around that 4,100, and I took the easy road out and agreeing broadly with consensus. Markets are down substantially, but there's still demand for equities. There's still a lot of investment dollars to go into the equity space. As we look at rates coming to a terminal level, Jamie Dimon this morning put a coin flip of 5% and a coin flip at 6%. If we sort of split the difference and say they end in the mid 5s to high 5s, that does mean at some point the Fed will need to take a pivot or at least a pause that will give the equity markets an opportunity to go and perhaps to take off a little bit. But I think broadly speaking, there's still a lot of great companies out there. And the easiest way to access those companies is through the equity markets. And there's still great growth to be had in those companies, even if a technical recession does occur. As you noted, it'll be one with very strong job demand and still high wages and highly productive companies. And although the prior recessions were ultimately turned around by industrials, this one will have to be turned around by technology. I don't forecast many people stopping asking for iPhones and subscription services for Christmas and going back to asking for horse and buggies or for large steel and iron projects.
Certainly. I mean, we know that they are going to be cutting back, though, as we already have seen some of that demand waning. I did want to get your take on earnings season. You mentioned Jamie Dimon, the big banks kicking off this Friday with earnings season. What are your expectations there?
We think banks' earnings will be good to strong. Interest rates rising does give banks the opportunity to make a heftier margin. And we think the banks have been well positioned. They learned their lessons from 2008 and have been more financially better managed along the way. I think they're very much afraid of recession. And as some of them have come out and started to cut aggressively, or to cut jobs aggressively, which I think is the right move for them to make. That said, we do note that the banks are, generally speaking, bigger in both assets and in terms of FTE than they were a decade ago. But given the lessons they've learned and just the underwriting standards they've put in and regulation, that some of which has been beneficial to preparing them for these sorts of events, they're very well capitalized and will do well to, even if there is a short-term or a shallow recession, they're well positioned to continue to earn hefty profits and to grow those into the coming years. So we're looking forward to a positive earnings season for banks.